Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.
Hello, my name is Michael Stoller. So where are we in 2010? What's happening? Where do we want to invest? Where does this crystal ball, I don't have my Apple with me over today, look at 2010? So I've assembled three of the leading fund managers and their counselor to talk about where they see the great opportunities in 2010. My guests, they include Craig Solomon, managing partner at Square Mile Capital, Paul Pariser, co-CEO and managing partner at Taconic Investment Partners, Jeff Barkley, managing director at ING Clarion, and last but not least, a frequent guest and a good friend, and the counselor to all of these people, Rob Ivanhoe, who is the chairman of the worldwide law practice at Greenberg Traurig. So, Rob, since you represent all these guys over here, and they ask for advice, and one time Craig was your partner, you know, but then he went to the dark side. Where do you see these people and your other clients looking for 2010 investments?
Well, I think they're just beginning to stick their head out from under a pretty dark cloud that's been around for the last year and a half, and looking at things that are opportunistic. I think a lot of them are, looking at distress opportunities more than traditional buying opportunities.
Prior to the show, we were saying that, Jeff, you said you have, directly you have $500 million that you can invest, plus you handle so many co-managed accounts. Paul, you have about $100 million that you can invest from your fund, and Craig, you have about $600 million. So I have about $1.2 billion of money plus other money out there. What do you like? What type of assets do you like? Are your appetite and you feel good about next year in 2010?
Michael, we're really at both ends of the spectrum. On one end, we are looking for the distressed opportunities that Rob talked about, where we can really step into something that's broken and fix it, usually with an operating partner, with a strong operating partner, of whom we have a few. And at the other end, we're also looking for core, because our investors do want core returns. Many of our investors never got heavily involved in leverage. They want a 7, 8, 9% unlevered return. And today you can get that, and you can get that with good credit in solid properties, in office, in industrial, and in some selected retail. We're very careful about retail. So we're really at both ends of the spectrum. I think where there's no capital availability right now is in the middle.
Now, Paul, over the years, you and Charlie have really been great investors and sold some of the properties at great times. But you own 111 8th Avenue. Today, you're converting Meadowbrook in Brooklyn over there. You have the building in the Bronx, and you have some multifamily. Where do you see yourself in 2010 investing?
Well, the things we're looking at, Michael, are really much more core than fringe locations. I think that if you look at the whole asset class, as the values have dropped. What was we were talking about in a preamble a transaction on Park Avenue, which we bought for $500 a foot and sold at $1,600 a foot. My guess is it's probably not worth $5, but in 2010 we're focused on much better quality assets in high quality locations. Haven't seen much, but we think these things have to be broken free and sold. And I think that our view is why develop? Why why not take advantage of rather more simple approach?
I mean, when you talk about that, I mean, you were the co-developer with Related of the Caledonia.
Correct.
Which was a
Our timing was lucky, fortunate. We sold all the 190 condos. We sold and closed. The 300 rental units have done great. We beat pro forma by $25 a foot. And so that was a great timing. There are many condo-type developments that are standing in deep trouble right now with banks that are not funding and partnership equity problems. Our timing was excellent.
Mr. Solomon, since you used to play counselor with this gentleman over here, and as I said, you went to the dark side to invest, and you have invested, but we're not talking about what you had. We're talking about what you really want. What do you see you and Jeff and your team doing in 2010?
Well, I think, Michael, it's a function of risk-adjusted return. Unlike Jeff, we are more focused on the opportunistic and distressed side of the business. So we see a lot of opportunity in buying cash-flowing assets at a substantial entry point where we don't have to add a lot of value. And then we think that the mortgage markets are going to provide tremendous amount of opportunity to buy both non-performing and sub-performing debt as an entry point to get to the real estate at historic values. Overall, we would have to say that 2010, 2011 is a significant opportunity as an entry point into the real estate markets, both here and throughout the country.
Now, Rob, prior to the show, you were saying that you're seeing a lot of deals, a lot of workouts. Now, that relates to something that that's not really something that you want to buy. If the great opportunity, you might buy that. What type of workouts are you seeing? Are banks making a decision to get it off their books, or are they doing the pretend and extend? What are you seeing the banks doing? Because
there's such a variation because you have different kinds of assets, you have different kinds of sponsors, and whether the loan is securitized, that's a new set of dynamics with special servicers being engaged. And if it's a syndicated loan with traditional banks, at least there's somebody more to speak to. The dynamics are totally different in terms of the outcome on these workouts, and it's really hard to generalize.
And changing month
Yeah,
to month.
and changing constantly. The special servicers are getting more engaged. I think a few months ago we all knew certain deals were going to blow up, and there's a lot of publicity about deals like Stuytown and other things. People have been writing about that for a year. Well, the special servicer was just activated a couple of weeks ago. Everyone had been talking about it for a long time, but nothing's been going on there. And in many similar deals, it takes a long time for anything to happen. So it's a lot of clogging.
in the early 90s, yes.
But Stuytown's a great example because we've all talked about opportunistic and we've all talked about core. And Stuytown, which was several years ago, as we all know, was as core an investment as you can get. It had below market rents. It had a waiting list a mile long. It had a fortress-like position within the market. The Stuytown,
great retail potential.
Great retail potential.
Great developmental.
Stuytown, in our view, and we were the cover bidder on it, and at the time we were very, very upset about that. But looking back on it, that was a core to the bone investment that had it been viewed that way by the equity market and the debt market, I don't think we'd be sitting here talking about it today. The key issue with Stuytown, besides the legal issues, was the leverage. And you haven't asked us yet about that. But
I don't think we're going to see that type of leverage in 2010.
I don't think we are either,
not for a
Michael. But
while.
that's the difference. In this market going into 2010 is going to be much more of a cash market with what I would call more traditional leverage, whether from traditional lenders like the insurance companies who are back in the market, or even as you start seeing the CMBS market come together with the sort of semi-TALF and now the post-TALF transactions.
In the 90s, there was the situation that certain, great example was Vornado, when they bought the Mendick portfolio, and then Macklowe nearly was ready to go take his properties public into that. Do
And
you
Witkoff
see,
almost
and,
went
and
public,
Witkoff
and-
almost went public. Do you see certain landlords going to the public market, both the public and the private public REIT market?
Well, I think you're seeing in a lot of asset classes, the first thing we saw was the mortgage REIT phenomenon, which was a window in time in 2 or 3 firms, the most famous of which was Starwood, was able to get out of the blocks early and raise a lot of capital for a mortgage REIT.
But Apollo wasn't able to.
Apollo wasn't able to. A number
Colony
were pulled.
didn't, a
Colony
number of them
pulled.
didn't.
A number
Ladder
pulled.
pulled
Ladder
also.
pulled. Now you're seeing it in the hospitality space. There are at least 2 blind pool hospitality REITs which are pricing, I think today actually, and the feeling on Wall Street is that some amount of capital will get raised. And you're also beginning to see in the office sector sort of the same kinds of rescue REITs that took place in the early 90s.
And you're seeing it in retail too.
Right.
Stewart Tans and retail opportunity investors, and so I think it's the equity is starting to come back into the market, as is the debt, but the balance is going to be much different.
But if you look at the aggregate amount of capital that's being raised in the public markets before those windows close, it's very, very modest. I think in the aggregate
It's
on the
very modest.
in
It's
the
hundreds.
mortgage REIT, that window has closed. The public market window's closed, and maybe $2 billion was raised.
If that.
That's a trickle compared to the $3 trillion
$3.5 trillion that's out there.
loans
yeah.
maturing over the next 3 years. A trickle.
You know, you bring up a subject which I've done some shows, and I did one earlier this season about the hospitality market. The nice thing is that I wrote an article a couple of weeks ago saying that the pipeline of new construction is down. A lot of property has been down, but there is a lot of new product coming online, and
Still,
you know,
yeah.
it's still coming online. What's your thoughts? And I know that you guys are in one hotel in New York, and I
We're
think
very, very bullish on hospitality, especially in New York, but throughout the country. It's a very, very tough asset class because it's as much an operating business as it is a real estate play. But if you look at the history of the hospitality sector, it gets hurt the worst, and it
But it
snaps
recovers
back
the
first.
fast.
And hurt
Recovers the
first.
first. And what's very interesting about it, it's very transparent in terms of underwriting. If you have an office building, you're looking at long-term leases with not a lot of transparency into the underlying credit of an office tenant. If you look at a hotel, not only can you get real-time daily, weekly, and monthly information on a target asset, you can get it for the comparable set that you're comparing it to.
your only problem is each day it's the new register. You have to hope.
And that's
that-
the good
That's the
news.
potential.
That's the good news at the bottom, going to a top. It's the bad news when you're at the top, going to the bottom. So with ADRs nationwide down 30%, and occupancy being maintained. Well, occupancy has been largely maintained in most markets. It's the top line that's getting hit. When you're down 30%.
It's a highly segmented market. though.
I mean,
Yeah.
the
is.
New York market, you know, in January of 2009, rates were down about 40%, occupancy was down. The rates have gone nearly as high, you know, they're down about 25%. So the rates are a better situation. And the hotel market has really recuperated itself over the last couple of months over here.
It has.
And
the
the
pricing
fact,
hasn't. The
right,
pricing
but-
hasn't. That's
and the fact that a number of these hotels which were planned are not going to take place.
And a very weak dollar.
And the weak dollar is helping over there.
And New York is it's a market unto
It's a
itself.
different market. Now, look, you've invested in retail. You have the Apple Store. I mean, in the meat market. What do you see the meat market? You own 111 8th Avenue. Do you see that market still being strong? People wanting to do a lot of things.
I hope
over
so,
there?
since Craig's fund and our fund own two new assets in the meat market. It's weaker than it was. Our rents topped at upwards of $500 a foot for prime meat packing retail rents. They're down 30% probably. There's still tenants. There are still tenants out there, just like the office market. The office market probably is off on a gross basis 25% plus more TI. So you have all those
Office
things
market
working
is
against.
probably close to 40% off when you take everything into
Depends on
consideration.
Overall.
Well, your net
When-
effective.
when your
is-
net
your
effective
is
is-
going to be way down when you
Net
factor in
effective is
free
40
rent.
to 45 or 50.
Right.
But there's still a market.
Now, you know, I don't want to be myopic in the borough of Manhattan. What is your thoughts about? I mean, Rob, you're in Connecticut. I mean, recently Starwood made a major move. The city White Plains was very
Stewart
upset.
Hotels, yeah.
You know, very upset that they lost the situation. But effectively, I think the chief of the economics for Westchester said, I couldn't. It was a $40 million gap to get a tenant over there. What's happening in the White Plains and the Westchester market? And as an investor, would you get involved? I mean,
Westchester and the White Plains area in particular, we actually have an office there. It's a very flat market. Even when times are good, the rents don't go up very much.
It was flat
And when times,
in the boom.
right,
It never
right.
really
It's a
took
lot
off.
like New Jersey office, where things don't change that much. You look back 20 years and the rents haven't gone up very much, even in good times.
now have you?
Westchester's
so
a great
rents-
place to live. When I lived there, but it's been a consistent underperformer.
So
in
this is
office
not
and
this is not
retail.
an ING Clarion investment.
It hasn't been. We've owned a couple of assets over the years in Westchester, and we've sold
and
them.
Greenwich?
And in Greenwich, we've done extremely well in Greenwich, and that's a wonderful office
Did you sell
market.
those assets?
We still hold that. We bought an office park in Greenwich in 1997.
Wow, that
and
was
it has returned, I'd say, in excess of between 15 and 20% over the holding period. So it's a great asset.
We own assets, office assets in Westchester, and we're seeing no green shoots. It's a battle to keep tenants, and most of the large tenants that have moved to Stanford, the Starwood deal, and before that RBS Greenwich Capital, was really driven by the principles of those firms. It wasn't driven by the underlying demands of their employee base. And with what's going on in Manhattan and in Brooklyn, I think the drivers into Westchester have really fallen off the face of the earth.
There was
It's
a-
very
yeah,
tough.
there
Right,
was
there used to be more
a-
impetus than before than there is now.
It was
so-
even tough, you needed $30, $40 net effective rent differentials to make sense.
When
but
Manhattan,
no one
and
moved.
it's
when
shrunk.
Manhattan got so expensive, it's like filling more water into a bathtub. Eventually, it's going to flow over and run out. Obviously, in the Manhattan market has softened dramatically. There's tremendous amounts of space, so you can be on Third Avenue for rents that are, much softer than the past.
Now you've gone to Brooklyn. I mean,
We've gone to Brooklyn.
You've gone to Brooklyn.
for residential product, not office product. There's no significant office product other than Manhattan. We have a converted, very interesting converted building in the Bronx. It's not what I'll call traditional office. There's a couple of million feet of offices in the Bronx, but the office market's all Manhattan. Our move into the boroughs has primarily been residential, which is more stable.
With regard to that, I mean, you represent many people in the residential. You wanted to invest. Is that your preferred asset class for 2010? Do you think residential is the good opportunity?
Well, given our mandate, which is opportunistic, higher yielding returns, I would say no, because we can't get the yield. Our preferred classes would be hospitality, retail, and broken condominium plays.
So you're talking about what kind of yields do you want? I mean, how greedy are you? what do you have to return to those investors?
Yeah, I don't think it's a function of greed as much as a function of the asset allocations that have been made by our investors.
So what
who
do your
invest
investors
long-term.
want? They want over 20% return?
They're looking for net 12 to 15% returns.
And what about
But
you?
tell
To
us what
them.
the gross has to be for them to earn
17
that.
to 20%,
That's
which
the
drives you in a different direction, keeps you out of core.
And you?
Well, first of all, you started the show calling us a fund, which I'm very grateful. We do have a fund, but we're really operators.
You're an operator, right?
Yeah, so we have multiple baskets. In fact, our fund's finished with its investment program, so as we go forward, we're back to being an operator. So we look to partner with both of the gentlemen in the room.
And the
Rob
consular will-
Services.
we'll find you some
This is
more.
a very good team for us. So we
a
cover both
virtuous
sides.
circle or
But as I said
something like
before, I think there's going to be a greater upswing in higher quality assets as long as you have access to just a lot of cash for the deals. You're not going to get the leverage, so you need a different sort of venture with a different type of investment.
So let's look. There were three office assets, basically, three or four office assets that sold last year.
Correct.
One was 1540 Broadway, the condominium interest
Right.
in the tower over there, Worldwide Plaza, and then your
HSBC building.
right, and then the HSBC building. You're a fund.
Well, we're not a fund either. We're an investment manager.
Investor,
and we've
but,
got
but
a dozen different pockets.
Did you look at those?
We
or-
looked at every one. We have a team that scours New York, that looks on market, off market, talks to Paul, talks to some other operating partners, and we looked at all of them and couldn't make sense of any of them.
We got excited for Fifth Avenue. I think the tower in that building is good. The retail's a little difficult. I would say difficult. Bryant Park's a good location. We proposed, we bid, but we bid what wound up to be 20% off the winning proposal. Don't know how quite they got there because there was very little leverage. There was about $115, $120 million of leverage available from institutional lenders. My guess is that at the end, maybe HSBC financed these fellows. We don't know that. Or maybe they just had a different sense of values.
It was also foreign investors. You know, it was
Well,
cheaper.
foreign
it was
investors with local skill
operating
sets.
partners, but
My guess
the
is
money
they-
came mostly from Israel.
There's got to be a winner.
We looked at each of those two deals, and we judged the absorption time periods to get those properties leased up to render our ability to achieve our returns to be almost moot.
Now, there's a transaction that will probably close in January, the 4 New York Plaza transaction, which is an office building which will be 70% leased back by J.P. Morgan. Was that a type of transaction that you would have looked at? I mean, Lower Manhattan, you know, there's been a mixed emotion. I mean, not all of your clients really like Lower Manhattan, I know. What's the thoughts about Lower Manhattan in general?
We have not focused on Lower Manhattan. We've gone as far afield as 111 8th and Jersey City, but we've stuck pretty much to the more established neighborhoods.
I mean, I think Lower Manhattan today, it's you've got to meet the standard of dirt cheap. If you can meet that standard, and that's probably $100 to $125 a foot for lesser product, and maybe up to $200 for the best product, then it's probably a reasonable bet. That's shockingly low relative to the last 5 to 7 years.
There
It's
are
all
just
about the
too many
basics.
question marks for Lower Manhattan for us right now, with the Port Authority and Silverstein's properties. Will they go? Will they not go? With Merrill Lynch, will they stay? There are some very big blocks of space in downtown. The core tenant base was the most hit a year and a half ago or a year ago. They were the core of what was hit, and the tenants that remained, a lot of them prefer Midtown. So if you look at downtown from residential conversions, like it. Office market, tricky and challenging. Certainly, it's early in the gamble. They might be very right, by the way, but it's a little early in the gamble.
Paul, if you look at the sort of the B office stock down there, occupancy has been maintained. Those rents never ran up, and today a number of those buildings can be bought where $25 to $30 gross rents can work.
And those can work.
Yeah.
If you can buy a $30
Not that
gross,
we haven't done it, but
which is a $12 or $13 net, and you take off, you can cap that at a rate 9, and then take off the TI, and you're probably down to about 100 a foot.
Yeah.
Michael,
Then
one of the
those work,
differences between this time around and last time around, including in New York, but nationally as well, is that you have the public companies, you have the big public companies, and the Brookfields and the Vornados and the SL Greens. We didn't have those, and it was, I think, a more fertile playing field in the mid to late 90s for the entrepreneurial company and the private player.
But we don't see those public companies investing in New York City.
And I find that fascinating.
But they're not going to play in the smaller. They're not going to play downtown B. What Craig was
They're not
talking
gonna play
about.
downtown
They're
B.
going to go for the big trophy.
I mean,
hunting assets.
when I had Mort
think that
Zuckerman
they'll
on the show,
stick their nose out probably in 2010 or 2011.
that?
Well, they've
Yeah,
spent
I
this
do.
year recapitalizing.
And
They've spent this year
very
shoring up
big.
their
They wanna
balance
add a lot of
sheets.
their balance sheets.
And I think a
Vornado
lot, some of their money has been defensive and some of their money is offensive. And so if you're looking for trends for 2010, I think the public companies are going to be back, even in New
agree.
York in 2010.
I agree with that.
I agree. I think 2010.
I think it's going to create a
2011.
real differentiated marketplace, not only in Manhattan, but throughout the country.
And I'm not sure I'm happy or sad.
It's another source of
And
capital.
they can
Well, I
buy
think
with a
it's-
lot
it's-
more
it-
equity, and I
For
think that they will.
that which we own,
For
we're
the-
happy.
Well, and in terms of better quality assets, I think it's going to be very challenging to manufacture returns when you're competing against the public markets.
Right.
Well, yes.
So
Yes.
listening to this, it sounds like all of you may be causally optimistic for 2010.
I think we're all of us basically the glass is half full kind of people. Otherwise, we wouldn't be doing what we do for a living. We like to see opportunity. It's been very negative for the last 2 years, and I think as long as you've got the right capital that can adjust to the situation, looks like everyone has capital.
You bring up an interesting thing. When was the last time you made a purchase?
Our last closed investment was in July. It was retail and it was a net lease in California.
And prior to that?
And prior to that was early 2008. So we spent a little over a year without making an acquisition.
Paul?
Well, I guess about a year and a half ago, it was a transaction we did with Square Mile Capital. It was a first mortgage loan at a high price on some meatpacking district deals. It's nothing for the last year and a half.
Greg?
Up until Friday, we hadn't done a deal in 15 months other than the deal that Paul described. On Friday, we bought a retail asset in the Southwest from a special servicer.
At $15 a
The
square
Third
foot.
Avenue East Side,
At
Southwest?
15.
Rob, what are you
$15
saying?
a square foot.
Your clients?
What?
Third Avenue East Side?
Well, I think they're beginning. Certainly, some of them are looking at opportunistic investments. Some of the large funds are looking at doing FDIC deals. Where they put these very large pools together. It's a tremendous amount of brain damage and work, and you don't know if you're going to succeed in the bid, and then when you do, the package just requires a tremendous amount of work to go through. But there's going to be a lot of FDIC portfolios that are put on the market in 2010 and 2011, and there will be people looking at those.
I mean, we had 130 bank failures.
Yeah,
Right.
I think
There's
what
a lot of
you,
real
I think
estate
what you
embedded in
found,
there.
because we track the FDIC auction process very carefully, we're registered. I think what you found is that the assets that are being sold are the loans that were made by the weakest banks in the banking system.
Yeah.
So as a result, the underlying product is among the worst. It's land
It's
that doesn't-
adverse selection.
It's adverse selection. It's land that doesn't deserve to ever be built on. It's condos that should never have been built. It's strip shopping centers that should never have been built. So we have largely avoided those auctions. We have not liked the product type.
So, in summation, I think, as Paul said, the glass is half full, and hopefully it'll get fuller. And I'd like to thank Craig Solomon, Paul Pariser, Jeff Barkley, and Rob Ivanhoe. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Wickoff Group.